So thank you, everyone. As it has already been said, this panel is going to be held in English. So those of you that need any translation, please feel free to get it. Okay, so thank you very much. We have several challenges today. We are the last ones, the last panel. And our business, I don't know if it's at the same top interest as the two other topics we have been discussing today. So we have the challenge of making it as interesting as possible. But I'm very happy to have here, I'm very honored to have this panel, this distinguished panel, I would say. They are not only very good professionals in this field and in this market since already a long time ago, but they are good friends. So I hope we make the discussion as lively as possible and that we just jump in the several topics we want to touch. I'm going to be very brief in the presentation. You do have their CVs in the documentation that we have already which is available for you, so I'm going to be very short on that just to keep the time under control. I have the pleasure to have with me Dan Riordan. Dan is the President of Global Political Risk, Credit and Bond for AXA XL. We do have Andreas Klasen. Andreas is Professor of International Business, and he's the head of the Institute for Trade and Innovation. And in fact, he has been working very closely with nearly, I would say, a very big number of ECAs and from development and multilateral agencies. And then I have Jonathan Joseph-Horne. Jonathan is the Managing Director, Global Co-Head of Structured Export Finance in Sumitomo Mitsui Banking Corporation in Europe. So I think that we are going to be ready to have a bit of to look at the market from different angles. We do have a banker, we do have a private insurer, I'm a public insurer myself, and then we have Andreas that knows a bit more about also not only about ECAs, but also about multilateral and development agencies in the market, which are really gaining a lot of weight on there. The first thing I wanted to check with you, and that's going to be our introduction. You know, the title of this panel is Export Credit Insurance, Evolution or Revolution, and that's a good discussion to have. It's the trends we are looking and we are seeing in the market. Are they really a revolution, or this is something that is going on since a bit of a long time ago, or are they gaining the momentum of changing dramatically where we are operating and the business we do have? I would let you, the time you need, the three of you, just to say which trends you see in the market, and if you will decide that this is an evolution or a revolution. Who wants to start? That's great for me. Jonathan, that's your
Sure.
turn.
Thank you. Thank you also for the invitation to be here. Evolution and revolution, it's a difficult one. Are we seeing rapid change in this market? No. To be honest, no, we're not. Are we seeing fundamental change under the surface? That I would say, actually, yes, we are. I think in this market, it's very important to peel back the layers and look beneath the headlines. I think if we do look at the headlines, look at the market trends since the financial crisis, deal volumes, depending which provider you look at, are broadly flat. They go up and down a little bit. Last year was down 20% on the year before, but up slightly on the year before that. So generally speaking, volumes are reasonably flat. Under the surface, though, I think we are seeing more kind of fundamental change taking place. I think we're seeing at the moment a decline in the very large deal volumes that we've seen in the past, some of the very large project finance transactions. I think that's being replaced by a greater variety of transactions. And I think one of the interesting features that we saw of last year was that, unlike previous years, we saw a kind of flattening out of some of the trends in terms of geographic concentrations. There was far fewer geographic concentrations, so Europe, Middle East, Southeast Asia were reasonably well balanced, which is the first time we've seen that in a number of years. Likewise, from a regional perspective, from a sector perspective, oil and gas. The reality is oil and gas continues to be the dominant sector. But again, if you peel back a little bit, we're seeing an increase in transition capex within oil and gas. Power continues to be very strong. but we saw last year renewables being renewable power exceeding non-renewable power for the first time ever. So I think when you peel it back, it looks a little bit more interesting. And I think then, you know, we do operate in a healthy market, but I think we can't afford to be complacent. But in terms of your specific question on, are we seeing revolution? No, but there is a but here. I think what we need to differentiate a little bit is direct revolution from indirect revolution, because what we all do is we provide services to underlying users, whether it's finance, whether it's insurance. Yeah, we are providing a service. And I think that there's a fundamental point that the industry is covering, and that is it is facilitating revolution by other parties. So if you look at 5G or data centers, sustainability, the headline revolution areas, they're all being supported by areas such as export finance. So even though export finance may be seen as being sort of plodding along and in a slightly sort of flat way and not in its own direct way being a revolutionary leader through its own inherent adoption of fintech within the ECA world, for example. Nevertheless, we are financing and supporting the revolution of others.
Thank you, Jonathan. Andreas.
Yes, thank you very much, Beatriz. Thanks, great to be here. I tried to focus with regard to the first question a bit on the public policy intervention on trade policy, trade finance, export credit insurance, but also development finance. And I think for me it's obvious that we live in a world of change and we live in a world of disruptive change with regard to the policy interventions or the government interventions. And I try to think about different layers or levels. So, and if I think about a revolution, I think we have a revolution with regard to 3 different layers. The first one is really the policy level. We see multipolarity, we see fragmentation, we see institutional inertia with regard to everything around trade and trade policy. And of course, there is an effect on export credit instruments, on export credit insurance instruments as well. And I think you see that on the strategy level as well, that ECAs can be, I mean, we are not there, but I think we are pretty close. ECAs becoming trade war tools as well. I'm pretty happy that Donald Trump has not realized that US Exim Bank can be this weapon in trade, but I'm afraid that there will be a day then he wakes up in the morning and starts to Twitter that US Exim will be his tool, his weapon in export support as well. And of course, with regard to processes, there is a digital disruption. We discussed it in the morning in the other panels, and of course, we have the beginning of a digital disruption as well in this world. And evolution is definitely there, an ongoing and accelerating evolution from my point of view. And I think we can think again, look at these different layers. The policy level, what we see, and we have done a big study last year, as you know, on the convergence of development finance and trade finance. And this is a reality from my point of view, that institutions formerly looking at job creation, domestic job creation, the ECAs, being insurers or lenders of last resort, the ECAs, are now in competition with development finance institutions, initially looking at an additionality, at catalyst effects and development in least developed countries or emerging countries, but now focusing much more on national interest and also focusing much more on trade. So there is a convergence, there's collaboration, which is good, but there is competition as well. On the strategy level, as I said, I think we're not there regarding the trade war tools, but we are definitely there that ECAs are becoming part of what we call a strategic econ system. So a embedded tool in policy, on industrial policy, and innovation policy, and export policy, and more becoming a solutions provider. So really looking at a coherent approach with regard to their products. It's really the solution idea and what drives their activities. And that is, of course, related to products. So formally, if we think about or we thought about ECAs, it's an insurer of last resort, full stop. And then much more activity regarding lending as well. now I see that it's really the full value chain. It's knowledge products, it's risk mitigation, it's liquidity, providing liquidity. So again, we see an ongoing and accelerating evolution. And the final point I want to make before I stop here is really processes as well. So I mentioned the digital disruption, but also I think that the angle of looking at a client-centric perspective has become reality for ECAs, but also for DFIs. And you can add the box if you think about multilateral development banks as well. So I think a really challenging time, really interesting time, a lot of revolution and a lot of evolution going on in the ECA, the DFI, and the multilateral development bank world.
Okay, thank you, Andreas. Dan, it's your turn.
So I thought it would take a little while before Andreas would invoke the name of the President of the United States. I'm an American. But I think it was in the first 30 seconds of his remarks. But we'll come back to that. That's okay. Beatriz, first of all, thanks to you, Fernando, Inez, Carmen, all of you, great hosts. Thank you very much. So from my perspective, I'm a private insurer, right? So I'm with the AXA Group, and we're one of the largest private insurers of credit and political risk insurance. We also provide some bonding as well. I would say the disruptions in our business maybe happened 20 years ago, significant disruptions, and I'll get to that. And I think now it's been more evolution. The disruption was, I actually came from the public sector. So like Beatrice, I was a public insurer. I worked with OPIC, the Overseas Private Investment Corporation. I started as an intern there, and then I left as the head of insurance before I joined a private company to start a private political risk insurer. One interesting thing that happened for me in moving from the public sector to the private sector is that I realized, in terms of the operation of the business, most private companies buy reinsurance. They buy a reinsurance treaty to manage their risk, to spread the risk. They hold on to a great deal of the risk, and then for good management principles, they spread the risk. So my first meetings actually were with some reinsurers, and when I started this 20 plus years ago in the private sector, and a number of the reinsurers said, you want to provide support for infrastructure, you want to provide medium and long-term type of coverages. We don't do that in the private sector. That's really the responsibility of the government. Right, and the government players. And I think that was a bit of a wake-up call for me as a private insurer, but I didn't give up easily because I actually saw that there was a growing need for the private insurers to also play a role, often alongside ECAs, multilaterals, or in partnership with them, but there was an opportunity to grow. So we started our first business providing 10-year capacity, and then that has evolved to 20-year capacity, and also large figures that are needed to support infrastructure investments. So I think that, and that was 20 years ago. Now we have 60 competitors in our business. I think we were one of 22, 23 years ago when I started a private insurance company for this purpose, we maybe had 2 or 3. Now there's 60 different companies involved. So there's a lot more. So that revolution kind of led to the evolution and the growth of the business, and it's led to really innovation in products, starting with short-term credit, which went to more medium and long-term credit, non-trade credit, expansion of political risk type products, the involvement of financing of mobile assets, in insuring mobile assets of aircraft and shipping and things of that nature. That's grown quite a bit, and I'm actually very proud of the fact that we've been very staunch advocates of trying to promote through our insurance renewable energy and energy efficiency projects. So there were some years in the past when there was a lot of coal coming out, right? I'm delighted to work for a company actually that doesn't support coal at AXA, and we don't support coal, but we also look at the energy efficiency innovations that are there and actually can target, because we don't have to insure everyone, but we certainly can use our capacity in that way. And knowing that our customers are largely banks, large corporates, infrastructure developers, and increasingly, and I'd say this is a big evolutionary change for us, is increasingly working in partnership with multilaterals, export credit agencies, and development finance institutions to help them manage their risks.
That's good, that's relevant. I agree with your view. I don't think we are facing a complete revolution in the market, but the situation, there are specific trends that are here since perhaps 2 decades ago already, but there are a lot of elements that make the market completely different of the market it was a few years ago, and I think that they all have to do with regulation in every sense, not only related with banking regulation, also the OECD regulation that is applying to us. We are all the present, well, not you, but ourselves, we are OECD compliant, and that's really a restriction in a market, and this is making the competition grow, not only private versus ECAs, which that's good enough, we will talk a bit later if that's cooperation or how can we call that, but between ECAs, and this is perhaps more dramatic or much more different than it was before. We are really feeling the competition of our colleagues in other countries, asking our companies to go and build from their countries to have their access to their services, which is completely different. If we look at this 20 years ago, it will never happen. No? We were very much, we did have our own markets, and that was reserved for us in a way, no? And that's going to have a lot of impact. I would like to touch upon these trends you have already commented. One of them is the political risk as such. I think that if we talked a few years ago, we could say political risk doesn't exist, it's not that relevant. We were much more talking about commercial risk than political risk, and I think that's not exactly the case now. We are seeing some things going on and spreading very rapidly in some areas of the world, and I don't know if coronavirus is something also we can include here, not as political, but just as catastrophic, or however we would call that. Dan, can you start to elaborate a bit how you manage this from AXA?
In terms of the political risk, and I would say, I still remember reading an article, maybe it was 10 years ago, that said political risk is dead, right? So there is no more political risk. That with the growth of multilateralism, the growth of organizations who are building really a consensus around the commercial and economic code, that there would be no more political risk. We know that that did not come to pass. For us in the political risk insurance, in some respects, we were, happy to see that. That is our business, and we do support companies and banks and ECAs around the world with this business. I think the uncertainty is still there. It changes from time to time. It moves, but also the opportunities move, right? So I would say, where do I see us being most effective? Because we actually provide some credit, non-payment insurance, political risk and credit insurance, domestically, internationally, but I'd say I think of where we're most significant at times is in places like Africa, where you have 6 or 7 of the fastest growing markets in the world are in Africa, and that's where there's still not established norms in many countries. They're still developing. They're still developing that commercial code, the legal system. They need capital. They need infrastructure, and they need the support of ECAs, banks, insurers like us in those markets. And to take that risk and us to help manage that risk often serves as a catalyst for making that investment. And I think that's where I still see the great opportunities, but there certainly are continuing to be risks. I was actually quite surprised to see some of the difficulties in Chile recently, in Hong Kong, aside from the virus, but the political uprising, the income inequality issues that developed that led to significant damage in the market. So those surprises are still there. The uncertainty is still there, and that's often what we help to manage, is the uncertainty. But we also take great pride on the analysis, and I know your colleague is a chief risk analyst on the previous panel, right? That work on analysis for us is often very much importantly teamed with our underwriting operations. So hand in hand, we go in smartly to look at risks, and with our customers, we actually share with them our views. They may welcome it, they may not, but in terms of the partnership, we seek to obtain with them, we will share our analysis of the risks that are in, because there are always risks. There are risks in so-called safe countries. I mentioned a few of those that were considered safe countries, and then also in kind of the lower rated single B, double B countries, which many shy away from, but we also know, again, that there are tremendous opportunities.
I think if we link this with some of the things have been said this morning in the cyber security panel and in the sustainability, I think that in both cases it was clear that it was going to have an effect in the geostrategy of the world and how the different regions and different countries were going to react. So I really share the opinion with you. Jonathan, how you see as user and as our client, are you seeing a degree, is it growing, the awareness about this political risk in your organization? Are you looking more to this kind of risk, or is it still a small part of the decision?
It's always a significant part of the analysis, always. But I think that in the case of use of export credit agencies, most banks generally in the market make use of the fully comprehensive cover product rather than just the political risk product. So the direct impact of that political risk, therefore, tends to be more at the macro level, in the sense of its impact on things like delaying decisions, delaying investment decisions from sponsors or buyers. So the knock-on impact of capex, cash flow impact, things like that. So it's the sort of the knock-on secondary impact at the macro level that it has on trade flows, economic growth, investment decisions, etc., where it tends to be seen in my experience more from the perspective of the user of an ECA buyer credit.
That's very relevant. Andreas, you want to say something about this?
Maybe just two words. I mean, I totally agree with what has been discussed before. Maybe two additional aspects. One thing is political risk is a significant part of the cover of an ECA, that's for sure. The interesting development we see is that the classic political risk insurance related to investment insurance, which has been a really important product for governments, there is really not a lot of demand at the moment. And there are a couple of reasons why. Number one is, I think the private market has been so active and really so developed, not risk averse like 10, 15 years ago, but really a risk taker. So there is a lot of opportunity and there is significant growth, also due to the rising number of companies offering political risk insurance. That's one reason. And the other reason is that investment insurance, political insurance, is not very attractive from a pricing point of view if you go to the ECAs, which is good because then you don't need them. I mean, if there's a market, why do we have to say like have a government intervention, which is great. On the other hand, part of that I think is really the ECA's own fault. When they changed the premium system, some governments did that and tried to attach it to an export credit insurance related premium system, which is of course nonsense, sorry for my language, but it's a different risk, it's a different approach, and that's the reason why you see a lot of governments having an investment insurance, political risk insurance product with zero demand at the end. From a policy perspective, I would say ECAs and DFIs, etc., but mainly ECAs are much more relevant than ever because of this global policy uncertainty we see, and because much more countries are using the instruments, are ramping up the instruments, or creating new instruments. So if you want to be competitive as an exporter in Spain, for example, you need a strong Cesce public export credit insurance offering, because it's not only the existing ECAs being much more aggressive, it's also that more and more governments creating new institutions. Just two examples. We helped Egypt last year, the Central Bank of Egypt, to create a new export credit agency, significant amount of money. They want to put in 600 million equity as a starting point for a developing country. It's really a huge amount of money. Another example is Pakistan creating new Exim Bank. And you see, I mean, you know that from the Berna Union as well, you see so many new players in there. So that's a part of the policy uncertainty as well, that you need that support from your own government, otherwise you can't compete.
Okay, I agree on that. Yes,
maybe I
Dan?
just add to that.
Of course.
So I think your question too is like how we look at political risk within our organizations. I think it's an important point, that I think all of us here tend to be risk aware, not risk averse, right? But we also work in organizations where not everyone would necessarily share that same theory, right?
Only happens from time to time.
Absolutely. So I know for me, part of my role as being the global head of this political risk credit and bonding business is that I have to stay a step ahead in terms of educating my leaders in the company. Many of them really come from the property and casualty market, which they thoroughly understand property and casualty, but specialty lines sometimes takes a little bit more effort. So I very much look forward to those opportunities. I had worked at a company called XL Catlin, which was acquired by the AXA Group. One of the first things that I did is I really made opportunities to meet with the CEO, the chief risk officer of the AXA Group, to explain our business, because they were not that familiar with the business. And this is not a business that you want to be unfamiliar with, right? Because it's on the front page of the newspaper every day, right? Something happening. But I think that risk awareness takes time to develop, right? And we have the responsibility in our roles often to be educating our leadership of that.
And the other challenge is including all these different risks that are coming up in our underwriting process, which is really the biggest challenge we do have. So let us go into another subject, which I think is been very relevant, and we can look at it from different angles, which is regulation. I think that's perhaps the key driver of the market during the last 10 years. And here we could start talking about banking regulation. Jonathan, you are the expert on that. How does the regulation create different incentives or different attractiveness of our products for you, for the banking sector?
You are quite right that it has had a fundamental impact, sort of post-financial crisis, actually rightly so, rightly so. And I think that one of the challenges that our industry faces, and to Dan's point actually, it's education, because the reality of the export finance market is that it's a relatively small subset of a far wider market. For us, it's a fundamental importance, but in the wider context, it's very easy for it to get forgotten and glossed over. So one of the key elements actually in terms of regulation is education of people like the regulators around what export finance is, what credit risk is, what insurance is, and how it operates. And I think that one of the fundamental requirements that comes back the other way from the regulators post-financial crisis has been, yes, very interesting, thank you, prove it. And that's what they want to see. They want to see the data to back up the anecdotal evidence that we've all had for years and years about low default rates, high recovery rates, etc. So there's been a lot of really quite important work going on in the industry about providing the information and the data to back up the anecdotal evidence that we've all grown up with about the positive impact of trade and export finance. And I think that has very much helped correct things like the unintended consequence that we sometimes see by being a small industry in a far bigger pond, because decisions will be made and regulations proposed which don't, it's a one-size-fits-all approach to an extent, and then each individual area will need to then educate and advocate for the right treatment. And I think our industry has actually been quite successful at that. The work is ongoing. It's been successful in certain areas. The current area of activity is the provisioning of non-performing loans. It affects all of what we do here, whether it's insurance, whether it's export credit, whether it's multilateral. It has the impact, the potential to have quite profound impact on how the product is treated. So there's ongoing work in that area, and we remain ever hopeful that for positive responses. Certainly the dialogue that we're engaging in at the industry level, not individual bank level, but industry level, is constructive. So we are hopeful.
Just for you to know that in the Bern Union, we feel this subject is so relevant that we have just created a new task force, which is the regulatory task force. Dan is one of the co-chairs of this task force. And we are really getting and having a lot of objectives of showing the regulators and having an education dialogue with them, trying to make them understand which part of the market are we looking at. I think that one of the results is, as we see it in the market as ECA, we see that there are incentives created which were not intended, but they are there in the market, and I think that direct lenders are better treated than insurers, and that's one of the elements which is very relevant for those ECAs. We don't have any direct lending activity, and this has been like this since perhaps 10 years ago. I don't remember exactly. That's one of the points. The other thing is that competition between us, between private and public, is not fair enough, perhaps. You could argue, because the treatment also is not the same in the regulation. And the other one is that there is another piece of regulation which is not directly related to banking, but everything related with compliance that is affecting all of us, which is reducing perhaps our activity, your activity, and then our activity in some specific markets and in some specific segments of the market. And I'm thinking on small, medium enterprises. I think that small tickets, small transactions are very costly for you, and then we don't have that financing present in the market. I don't know if you feel this is something that you share this view on the effects of this regulation.
Yeah, absolutely. But I would push back slightly on that and say there's more to it than regulation. There's also all the processes that go around providing any type of finance. You know, whether it's a buyer credit. If you provide a buyer credit for 5 million euros, it takes the same amount of work as if you're providing it for 500 million euros. So, and that's not just driven by regulation, that's driven by other processes as well, everything from the application process to the OECD boundaries that we have to operate in, not creating an environment that necessarily inherently supports SMEs. So I think there are a number of different layers to it. Regulation certainly is one. Regulation, again, quite rightly, takes a lot of time and work, the onboarding of clients, the monitoring of clients, etc. There are economy of scales issues there which need to be addressed, but it's not the only issue actually. So there are others which create challenge in that segment as well.
Okay, there is another part of the regulation with the OECD regulation, and I think that now the market is completely divided between OECD compliant agencies and products and OECD non-compliant, because or they are not part of the OECD, those players, or because there has been developed a lot of products which are not strictly under the OECD regulation. How you see this evolution in the market? For me, the result is that level playing field doesn't exist anymore, and that was the objective of the consensus. And just to provoke a bit the discussion, some numbers that have been analyzed, and I think these were only 2017 numbers. Nearly the 50% of the business developed by OECD agencies are not OECD compliant, because they are not the products which will be covered by the consensus. I suppose this is something that has to do with the aggressiveness of ECAs and the change on their mandates. I don't know, Andreas, can you elaborate on that?
Yeah, I mean, I think really regulation is one of the most topical issues, and also regulation in this regard is, I think, the most significant disconnect between revolution and evolution. Why is that? Because revolution is the reality. You mentioned a couple of topics, but I really think the multilateral system for trade and trade support is on fire for a number of reasons. Number one is the relevance of the WTO, the agreement, the SCM agreement on subsidies is shrinking, but also the dispute settlement mechanism is totally blocked, it's dysfunctional now. I've supported the European Commission now for more than 15 years on the big trade dispute between Airbus and Boeing. Of course, not on the dark side, on the good side for Airbus. now, I mean, it's impossible to proceed with the panel decisions because there is no future panel. So that's one thing. Another thing is also the regional growth of regional frameworks is really rising. But if I think about this global level playing field specifically on the ECAs, there is a failure of this initiative we saw 10 years ago, the International Working Group with this new framework. I mean, in theory, it's still there, but in practice, from my point of view, it's dead. I mean, it's not going to happen. And that's the reason why the revolution is there, that there is no regulation on a global level, and there is no level playing field. And we see that with regard to numbers, with regard to products, with regard to approach, on strategy, on aggressiveness. And the evolution which should happen is ongoing, but it's too slow. And that's the reform of the OECD arrangement. Because I'm a big fan of a multilateral trade environment. I'm a big fan of rules and fair rules and regulations. But if I think about the arrangement, how it looks like, and what we should do, maybe that's not my personal opinion, but that's a discussion like simplicity, local cost to increase, a market reflective repayment approaches, revised premium model, a transparent interest rate support system, the SIR, a strong tool for matching ECAs from OECD countries with from ECAs from non-OECD countries. I mean, all these pressing issues, and where are we? We are nowhere, because it's not progressing. It's very slow, it's not efficient, it's not effective. And that's, as a result, really has a huge impact on Spanish exporters, on German exporters, on French, on British exporters. And that's the reason why I think, in addition to Basel III, Basel IV, we discussed for a number of years for other regulatory issues which are really relevant. But from an ECA perspective, the regulation is the most topical issues, it's the most pressing issues, and governments and we as international organizations, we are failing to deliver. And that's quite negative. I'm a super optimistic person. My glass is always half full. I mean, it's still very full, as you see, mostly full, but on regulation, I'm afraid we have really challenging times.
I agree with you. I'm also used to be optimistic, but not in the consensus
I'm
modernization, or
not.
however they call it, because I think that the objectives are not very clear there. It's going to take very long, and I don't think that really the objective is being flexible. I think that the objective, the hidden objective, is putting the regulation over all that part of the business that now is out of the regulation. So that doesn't seem to be very flexible there.
It's a significant challenge, right?
Yeah,
so we've seen, we work with more than 30 multilaterals, ECAs, and DFIs, and we've seen the greatest growth in the multilaterals, who are resurging in some respects or developing new. We have the Asian Infrastructure Investment Bank coming into the market very aggressively and with an enterprise risk management strategy that calls for private insurance to be part of each and every risk that they write. They didn't exist 5 years ago, really, and they're just still forming at this stage. We've seen the growth of DFIs, development finance institutions in Africa alone, where there were none a few years ago. We count 5 that we're working with, right? And that's just there. So, you know, the agency I used to work with, OPIC, now calls itself the U.S. Development Finance Corporation. And that was a change under President Trump, yes, it was. But really, the most important thing there is they were an investment insurance arm of the U.S. government. Now they are a development finance institution with a mission to kind of challenge certain governments who are lending aggressively for infrastructure around the globe. So, you know, that kind of political purpose expanded beyond what was really a self-sustaining, more developmental purpose.
And
So
they
it's
are
an
not
interesting
affected
time.
by the OECD.
And they're not
rules.
affected. They're not part of the OECD.
That's why they are filling that gap in the market, isn't it? Jonathan.
I have to say, I completely agree with both of you on this point. You know, this OECD point, I think, is one of the really sort of profound points for our industry. Like you, Andreas, I'm eternally an optimist, and so I suppose one of the potential positives, if you're looking for positives on a scheme that hasn't changed in 40 years, is that it has at least driven some of the innovation that we've seen from agencies and other providers to come in and find ways of bypassing the OECD framework to come up with solutions that meet the demands which are out there in the market. And you know, whether that's coming from agencies who will do more untied, or whether it's coming from agencies who develop other products which are outside the OECD consensus, or agencies who spend their lives outside of it, other DFIs, multilaterals, etc. So it has created an ecosystem that sits outside of the OECD, which is where we have seen really, I think, quite positive innovation across the market.
Yeah. I agree on that. Okay, so the result is that we do have a growing competition in the market. We are more or less the same players, but not the same players. We have new players coming in, and we have some of the players growing in specific sectors. And I think private insurance is one of these segments of the market that is growing very rapidly. You already talked about that, Dan. And how you see this competition with us, with ECAs? That's something that's annoying you, or we are?
No,
we
Beatrice, you never annoy me. But
we are benefiting, both of us, from that competition.
I really think the evolution, back to evolution, is that there's much more collaboration than arm wrestling for business. And I think it goes back, it's partly driven by regulation in some respects, the need for more capacity, more capital, the opportunities which remain. You know, I talked about Africa earlier, right? It's estimated there are over $200 billion of infrastructure needs each year in Africa. Less than half of that is satisfied, right? So the demands are still there. I think what has made more sense as of late is through organizations like the Bern Union, right? Which I'm the co-chair of a small committee. You are the president. But I think it's through organizations like that group, Bern Union and others, right, where private and public are sitting together, where we're inviting in, crowding in others for discussions like the emerging DFIs and multilaterals. I think that's where we can share knowledge. That's where we can actually do the most good, right? Not siloed and looking at how we are going to all compete for this, right? Competition is good. I have 60 competitors in the private market, but I think it's when we can get together and actually try to address the problems, right? Look at, sustainable finance. What does it mean? How do we define it? How should we be thinking about it? Being smart about environmental matters and other things. I think that most comes when we're sharing that knowledge among us. And I think and the capacities are needed. I mean, there's significant capacity demands. We saw great growth between 18 and 19. Now maybe 20 might slow a little bit due to the virus and the implications there, but I still think there's a lot in our pipeline, and we can't do it alone. None of us can do it alone.
I agree on that, and I think that this cooperation with privates, in our case in Cesce, it has only born a few years ago. We didn't have this reinsurance scheme with any private. We just did it with other colleagues from ECAs, where we were having transactions that were sourcing from different countries. But since perhaps 3 or 4 years ago, we are already doing that, and Africa is really the key. I think that in Africa, capacity is not enough with all of us working there. So that's really one of the main objectives on that. Andreas and Jonathan, how you see us, ECAs and private insurers in the market? Are we different? Can you see, you use both of them? How you decide which one?
You can start. Yeah.
Well, I suppose the best illustration of that would be that the team that I head, we call it structured export finance, and the products that we place within that are export credit agencies, multilaterals, and the use of the private market. So the products sit together in the same product area. So I think that's an illustration of the fact that we see them as being so interchangeable. So I fully welcome the way that those products complement each other and drive competition between each other. And I think that's completely healthy. That's the definition of a competitive, healthy market, in my opinion. So I think the more, and it's driven growth in our market. I think the different sources of finance available today are greater than they've ever been. I think the depth of liquidity that we see in the market, the sources of funding for a transaction are greater today than they've ever been. And I think that's because those barriers between the products have been broken down, and they are largely interchangeable.
Andreas, something to add?
Yeah, I think this discussion, this negative discussion regarding private and public is really a battle of the past. So I remember panels and discussions some 5 or 10 years ago when there were really an aggressive approach from the private market towards the ECAs, and I think that really changed.
There are still some examples.
There are still some examples, but I mean, it's, yeah, anyway. So what the colleague said as well is this crowding in of private sector is really the name of the game from my point of view, and it is required, and it's a positive impact with regard all to these innovations coming in as well, from a product perspective, from a process perspective, but also from a capacity perspective. Dan mentioned a couple of examples regarding the multilaterals. That's really an interesting trend I see as well, that there is much more collaboration with the private players between the MDBs and private insurers. AIIB just launched their new guarantee program. So we developed this new guarantee program for AIB last year. They want to do at least 5 or maybe even 10% of their portfolio in guarantees, and they don't want to do it alone. They want to do it together with ECAs, but in particular, of course, also with the private markets. So I see the main competition and the main challenge really regarding OECD, non-OECD, and development and export finance, these different layers. It's not the competition, from my point of view, a healthy competition, but not a negative competition between private and public. And I think, the final comment, the opportunity is really on how to solve together the pressing issues like, and you might cover that in the last question, on sustainable finance, on climate finance, on all these pressing issues, and how can we work together between the different institutions.
So that's good. We are talking about cooperation or competition. That's the result, and we are. I think we all agree on that. Just to remind you that you can make questions through Slido. We will be happy to answer some of those questions. We still have some time, and then we go to the other subject that you had just put on the table, Andreas, and this is sustainability. This has a lot to do with regulation, perhaps, in the future, not yet. And really, this, I see that in all the trends we have seen in the market, this is the most revolutionary, we may call it that way. How are you handling this discussion from your different institutions and your different angles of the market, and how you see is going to be our role in that specific area?
To start,
Dan,
I mean,
please.
so within the AXA group, there are 3 major initiatives that involve all of the businesses, and they include sustainability in the sense of focusing on water, climate, and financial. And those are the 3 key areas right now. And so each business within the company has had to develop their own planning along those lines. And I'm very happy with that. I think for us, we tend to think more on the financial because we work with a lot of banks and export credit agencies, and we're involved in facilitating funding through our insurance, often in projects. So we think of it in that lens. And to me, that takes us almost immediately to the risk analysis that we accomplish with our partners. We look deeply at the project risks. We work in a lot of challenging markets, but the last thing we want to do for both good reasons of sustainability and also for commercial reasons, honestly, is to support projects where the lending does not make sense, is unrealistic, that it puts an extra burden on a country that they cannot meet. Partly because we're involved in medium and long-term lending, and supporting lending of a medium-term nature. In the last year, I think Jonathan, you may have said it earlier, we supported 5 significant renewable energy projects in the wind sector. Those typically are 15 to 20 years in duration, each of those. That investment requires those longer tenors, right? A large part of our analysis is actually looking at the financial wherewithal for those projects to support themselves and where that will come from. So a very keen part. And then we're also quite keen on focusing on water as well, that is a particular area, and certainly climate, the impact of our risks that we are supporting on climate and climate change.
So that's very relevant. So you have decided in sustainability, which is a very big word, and it's
a big word.
Could be cover nearly everything. You have decided which objectives are the objectives you are going to pursue from your
Because
institutions
we
in it.
believe that it was important to focus,
Okay.
right? Because it is a big term. It means different things to different people. Those are the three
That's
areas
one of
that
the
we're most
challenges.
focused.
Thank you, Dan. Andreas, you want to jump in?
Yeah, it's a great subject because it's very positive. I think there are really the opportunities when we think about sustainability, and we might focus a bit on climate action as well. Why is that? 3 different layers. Policy layer, I think we all know that there are so many initiatives from the United Nations, from the OECD, on EU level. Also on the research and academic level, I just, as you know, yesterday I came from Oxford University. We launched a new research project together with 20 academics and practitioners from UNFCCC, from the University of Oxford, from Cambridge, from Offenburg, etc., regarding the new regime for climate action, in particular climate finance 2020 to 2050, which is a significant project we want to develop in the next 3 years. And you see that, of course, on the strategy level as well in all these public institutions, that SDGs is, I mean, you have to mention it, at least for publicity. The reality is that ECAs, DFIs, MDB is really implementing the question of SDGs, and climate finance is the most obvious one. And I think, again, this gives us the opportunity to work together between all these different institutions. Why is that? Because it's just a simple question of how much you need regarding financing. $579 billion 2017-18 tracked climate finance from public and private actors. If you think about the requirement on infrastructure investment and renewable energies in the next 10 years is significant. So what you need the portfolio of equity, of loans, of grants, of insurance, of financing, and you need all that from all the different institutions. And I think that's the opportunity for the ECAs. That's the opportunities for the DFIs and the private sector to do this jointly for a better world, but also to make business, because these renewable energy projects, they are really viable, sustainable, not only from a climate perspective, also from a financial perspective. Africa wind parks, I mean, rising, a lot of interesting projects going on there, so that's something where I see the opportunity, the revolution, both with regard to perception, but also with regard to action, and that's a good thing.
Jonathan?
I think most of it's actually been very accurately covered. I think there are, as with so many of these things, there are multiple layers to it. There's the regulatory layer in terms of things like reporting, defining, risk managing, etc. And then there's also the opportunity side of it. And I think that there's a really positive role that export credit agencies, multilaterals, insurers, and banks can play in transition CapEx and areas promoting the use of sustainable products, sustainable finance. So I think it's one of the huge opportunities that is presenting itself to us now. So I think it has the absolute capacity to come back to what you originally said, to provide revolution. And I think it's a really positive area where our industry can make a really profound and positive impact.
I agree with everything you said. Just to add from the ECA perspective, just to remind that ECAs, we have been managing this risk since, I don't know, perhaps more than 2 decades ago. We do have already OECD regulation that makes it necessary for us to make this environmental and social review. And in fact, I think that some of our exporters tell us that they have created their monitoring in this part because of our regulation, that at that time was very much questioned by everyone because it was an increase in the burden of our transactions. But I think we are ready to do that, and the challenge is defining what's sustainable, and that will depend on our policy strategy as a whole in each specific country, because the other challenge is to make it compatible with our mandate, which is promoting our industry. So we have to go in parallel with the transition of our industry to a cleaner thing, and that should be part of that process. I think that we have already run out of time, but if we do have some questions, we can just take, if our Secretary of State can wait just a bit, and we see if there is any question. There are a lot of questions. This is the first one. You want to answer it? Can you read it? What are your expectations regarding this coming trend, BPI, EKN, of some ECAs imposing restrictions on technologies from a climate change perspective? Just a short answer on that, and then I lead you. I don't think there is a lot of restrictions already on technologies. There are very few restrictions. It's only related to carbon and carbon itself, and that was already a bit excluded of our business in general, just for you to share. But if you want to answer that.
Maybe just one comment. I agree there are at the moment not many restrictions, but there is a trend already showing the DFI and the ODA world. And Sweden is one example. So SIDA guarantees, SIDA is only able to provide support or guarantees when there is something related to SDGs, in particular to climate action, climate finance, etc., etc. So it's too early to say for the ECAs, but it's already appearing, for example, the DFI world. So I think there will be a trend and there will be something related to climate action from a policy perspective.
Okay. Another question. To what extent can ECS portfolios might be impacted in the future by transition risk, since there is still a great concentration in oil and gas? That's a good question. We are really working on that. We have a lot of discussion. I think that here the challenge is we are not going to grow a lot on oil and gas, because the oil and gas is going to be incorporated in our risk analysis. And I think that the sector itself, we have heard a lot about that this morning, this is going to be included in the risk evaluation when it's a sector that is not going to grow in the future. And that's something that we have to take into account, and we are already doing that. So I think that the expectation is not growing that much in oil and gas, but give a transition to that sector and growing in the new part of our portfolio. So we don't envisage to decrease our oil and gas part of the portfolio, but increasing the rest, making it less relevant as a whole. And there are also other things we can do of compensating the carbon included in some specific projects. So we're still working on that. We don't have a conclusion yet from the ECA, and at least from Cesce's perspective. And this is a bit the same for everyone in the market. I don't know if you have an answer, a clearer answer for that, or a comment.
That was very clear.
That's good. Okay, thank you. Thank you, Dan. That's good. One about coronavirus. Coronavirus will, sorry, I don't. Ecuador's external trade, #1 world producer of shrimp exports, 95% production to China. Could this risk have been anticipated? Was it? I don't think we could anticipate, any of us, the coronavirus. This is one of those acts of God, if we may call them that way in our language, of political and catastrophic risk. Do you want to add something on that?
My hope is that we don't overreact or underreact to the situation. Actually, earlier during the break, of course, not when anyone was speaking, I went to check in for my flight on the United Airlines app to fly back to the States. And a new question popped up. And the new question said, if you've been to China in the last 14 days, you will not be able to confirm your seat. And so that's new. That's a little bit of a shocker. I've never seen that. So there's just a tab. All you had to do is slide the tab, and then I could confirm my seat. But it shows kind of, I think some of the concerns that are out there. We are seeing some slowdown in some of the movements, certainly of our business. I manage a global team. We have a very active office in Singapore. They're all working from home for the foreseeable future, and the level of activity seems to be slowing quite significantly. We're also learning, reading about bankruptcies and potential bankruptcies, particularly in China. And then really the supply chain is probably the biggest issue, right? So when I'm not an insurance executive, I'm a farmer. I have a small vineyard in Virginia, and I'm looking to expand it, and I'm buying some products online, and I just got a notice yesterday, because they are manufactured in China, they're going to be delayed, right? So, it's just one sign, a couple of signs to me that this could be a challenging situation. We hope that it passes quickly, because there's tremendous opportunities and growth in many markets, and it could be quite difficult.
We are sure that the economic impact of this crisis is going to be there. Yeah. In China, there are already a lot of supply chains which have been affected, and that's clear. And there are a lot of sectors and examples. It's not only Ecuador that was already said in the question, but I think that we are all going to see that. We will take another one. How is energy transition impacting ECS portfolio and risk cover policies? Andreas, do you know what the rest of the ECS... energy transition impacting
ECA's
ES's portfolio and risk-cover policies is a bit what we were talking about.
Yeah, I mean, it does. Two answers, maybe. On the one hand, there's still these traditional portfolios, and of course, it is very difficult to shift and give this push from an ECA perspective towards renewable energy, because you basically, as an EA, you're mirroring your own economy, and of course, you can incentivize, but then you have to really think about, do you want to subsidize it or just incentivize it? So how can you do that? So that's one thing. Of course, there is an impact in a number of countries, and that's basically Denmark is the perfect example. So of course, they have mainly wind in there because their economy is mainly wind, and that's the reason why they are lucky, because they can tick all the boxes. They support domestic jobs, and they support the SDGs and the climate finance goals, and they are really the good guys on the ECA side now. Yeah. So that's relatively easy. On the other hand, as I said, think governments have to understand and also to develop new solutions, how to push their portfolios towards a more sustainable portfolio, not only with regard to risk, but also with regard to the products they're supporting. But at the end, it must be a political decision, because demand will be demand. So you have to somehow push it if you want to do it from a political point of view.
Okay,
short answer.
No, that's very relevant, and I think there is another angle, which is that we really need to have regulation incentivizing the new technologies there. I think that's the element we really need to make it that the market react to that.
Yeah. And there are examples. I mean, there are examples. Yeah. The EIB, for example, supporting or subsidizing application fees for ECA cover. There's one example. Or this combination of innovation funds and export finance institution. That's another example. But you really have to do it, and you have to launch the political initiative. I think from an ECA point of view, it's very difficult to do it on their own.
That's very difficult, because to create an incentive, we are not flexible enough. We don't have so many things we can improve for a new, very clean technology. So we need banking regulation to make it easier for you, with perhaps capital reliefs for that kind of projects. And of course, again, OECD regulation being much more flexible on that specific and making it cheaper in a very direct way, however that takes. So we have a lot of work to develop that in this world. And I think we can get another one, just one, that will be the first one in order. That's difficult to answer. To what extent can risk or damages derived from cyber attacks be covered? I think they are included in our perhaps not specifically in our analysis, but in our comprehensive cover. You were talking about that before. Everything that has an impact in the financial situation of the debtor will be covered in a way. It doesn't matter where it comes from. I don't know.
Actually,
you see that?
That's a good example of the power of the product, the benefit of the product, the fact that it does provide that comprehensive cover, the BAL-compliant risk transfer, and it has to be that comprehensive. Otherwise, it doesn't give you those benefits. So I think that's a great example of the benefit and power of this product set, whether it's BAL-compliant insurance, multilateral cover, or ECA cover.
Okay, so.
Certainly covered in our insurance, and often, we're co-insuring or reinsuring with an ECA multilateral DFI, and it's covered. So, unless it's excluded, and there aren't that many exclusions, because our policies in the private market wouldn't be BAL compliant if they weren't, and you would not be able to receive much benefit, if any, without that.
Okay, so I think we have got to we have finished our panel. Thank you very much for your contribution and for all your thoughts about our markets. And let me just.
Thank you.